Everybody, welcome. In today's video, we're going to go over what kind of insurance companies should I look for when I'm doing an infinite banking type policy. Now, full disclaimer, I'm not going to list any specific companies because number one, they're not paying me to advertise. And number two, the individual companies actually don't matter. Whoever the top companies for infinite banking, they are always changing places year after year. The main thing is that you find a company that is infinite banking friendly, number one. And number two, the concept of infinite banking, the practice of it is more important than any individual company is going to be. So we're going to cover 5 things in this video. Number one, what type of company is it? So a mutual company versus a stock company. Do they offer a dividend? What's the track record of those dividends, aka how consistently has it been paid? 4, what's their financial rating? Number 5, are they a direct or non-direct recognition company? So let's get into it. So let's talk about number one. Are they a mutual company or a stock company? So not all companies that offer whole life insurance policies are created equal. And this is kind of where you run into, some folks that say whole life is a scam, infinite banking is a scam, is because the policies just aren't set up correctly. Unfortunately, that is a major component of whether or not infinite banking works, whether or not the legitimacy of infinite banking is a thing. The policies have to be set up correctly. They just do. So unfortunately, you have a lot of folks that, use the fact that they have to be set up properly as a detraction from actually doing infinite banking when, like I mentioned, the fact that whether they are or not set up properly is 100% a thing. It just is. So you can have if your more traditional whole life policy design is not going to have cash value for any significant amount until probably like year 3, 4, 5 at the earliest. You couple that with the fact, let's get into the question at hand, are they a mutual company or a stock company? So you want a mutual company. Why is that? Well, the policy owners with a mutual company are the company owners. So the dividends, mutual companies pay dividends to the policyholders. Now you have a lot of folks that say, well, a dividend is just a return of premium, which it is. So what are dividends and how are they calculated? We'll get into this a little bit more later in the video, but a dividend is essentially the revenues of the mutual company minus the expenses, and then whatever's left over at the end of the year is the dividend, and that is given back to policyholders. Now you can do a couple things with the dividends. That is, you can take them as cash, you can use it to decrease your out-of-pocket premiums, and you can also use them to buy more paid-up additions. If you've been following along with infinite banking for any length of time, hopefully you know that we use the paid up additions, or we use the dividends rather, to buy more paid up additions. What is the difference between a mutual company and a stock company? Both might pay dividends, but with a mutual company, they do pay dividends to the policyholders who are the owners of the company. With a stock company, they might pay dividends, but those dividends are paid to the stockholders who may or may not be policyholders. Now, if we rewind a little bit back to what I said earlier with your more traditional whole life policy designs, sometimes when people get a whole life policy thinking that they're getting into infinite banking, and then 5, 6, 7 years later, they have a minuscule amount of cash value relative to what they've paid into the policy, there's more than likely because that policy was set up with a stock company, not a mutual company. So number one, we need to make sure that the type of company that we are purchasing a policy through for infinite banking is a mutual company. If you're getting a whole life policy specifically for the death benefit and permanent coverage, that's a whole other story. Stock company could be okay for that, but for infinite banking, we want a mutual company. This brings me to point number 2, which we've kind of already covered, but do they offer a dividend? Does the insurance company offer a dividend? In which case, like I said, you want it to be a mutual company, because the mutual companies are paid, if you're keeping score, the mutual companies are paid to, or the dividends are paid to the policyholders who are also the owners of the company. The dividends are probably the top 2 most crucial component of a policy setup for infinite banking, because as I mentioned earlier, with the dividends, you can buy more paid up additions, which is going to increase your death benefit, which is going to increase your cash value. Without the dividend, this ain't going to work as well. So let's talk more about how the dividend is even calculated. So as I mentioned, the insurance company will take the revenues, which are premiums, obviously, And then also revenues from, say like their investment activities, their lending activities, because they got to grow all this money somehow because they're guaranteed to pay, they have to pay out the death benefit. So your premiums, they have to grow. They're required to grow them. They got to figure it out. So with the dividend, they take the revenues and then they estimate what their expenses are going to be. Their expenses will be like mortality claims, aka death benefit payouts. Obviously, these companies have employees, so those folks need to get paid as well. Any administrative costs with, policy loans, policy enforcement, so on and so forth. And they subtract those expenses from the revenue. Anything that's left over, that's what your dividend is. That's where it comes from. So to circle back to point one, with mutual companies, it's in their best interest to keep expenses as low as possible while maximizing revenues, so they can pay as high as dividends as possible, so they keep you, the policyholder, around continuing to pay premiums. And the longer you pay premiums, the better your policy is going to work out in terms of growth and access to capital. Number three, what's the track record of the dividend, aka how consistently has it been paid? So with the big mutual companies, a lot of these insurance companies have been around for hundreds of years, a lot of them. And if you think about why, insurance companies are in the risk mitigation business. Like they, in order to stay around, they have to keep making money. So they're going to do whatever they can to not have to pay out death claims or to estimate, how to basically find a way to estimate how to keep death claims as low as possible. The best types of mutual companies have been around like since the turn of the century, not this century, but like 1900 turn of the century. And a lot of the best companies have a proven record of paying dividends through the Great Depression, through World War II, through the dot-com crash, through 2008. Like all the best mutual companies have paid dividends throughout these different crises. Obviously, the dividends are going to vary because of the economic times, but you want a company that's paid a dividend. Part of the reason that you're even looking at infinite banking is because of the guaranteed growth that these policies offer. So if you want as sure a bet as any, you need to look for a mutual company that's been around for a while. Number four, what's the company's financial rating? So there's a bunch of different companies that measure the financial strength of insurance companies. You might have heard of them. There's Standard & Poor's, Fitch, AM Best, Moody's. There's a whole bunch. But there's one that kind of aggregates all of those different scores from those different ratings, and that's Comdex. It's a score of 1 to 100, 100 being the best, 1 being the worst. Basically, it's just a measure of the financial strength of an insurance company. How likely are they to pay a death claim? How likely are they to give you the money that you need when somebody dies? This essentially is what this rating is about. So you want to look for a company that has a really high Comdex score. There's plenty of really solid mutual companies that fit that bill, but there's only so many mutual companies. Number 6, are they direct or are they non-direct recognition company? This is probably going to be the most technical. This is going to be the most technical that this video gets. Essentially what a direct recognition company is that say you have $100,000 access to cash value. You can borrow as much or as little of that as you want. Let's say you borrow $20,000 of that $100,000. Well, the direct recognition company is going to essentially recognize that $20,000 is out of the policy, so your cash value is now $80,000. So essentially what happens is you get 2 different rates of growth for the cash that's borrowed versus the cash that is still in the policy. There's also non-direct recognition, which is the opposite of that. So say if you borrow that $20,000, that $20,000 is still going to be in the policy, having the same growth rates as it would if it were in there. You're not getting 2 different growth rates for borrowed capital versus not borrowed capital. Which one? It might sound on paper like non-direct recognition is better, and a lot of people do prefer that. But depending on who you ask, the non-direct growth versus the direct growth, it kind of winds up being the same. But a lot of these mutual companies are non-direct recognition anyway. And the direct recognition companies, after a certain length of time, your policy switches over to non-direct recognition. So you'll probably, if you've been researching infinite banking a lot, you've probably heard these 2 terms. It really doesn't matter. It's just a personal preference. But at the end of the day, it really doesn't matter. The most important thing to remember This will kind of be bonus number 6. Bonus number 7 is dividend rates are going to go up and down. Although with a high interest rate environment that we're in and heading into now, arguably, like the dividend rates typically go up. And then number 7, the individual, like I said at the beginning, the individual company does not matter as much. What matters as much is, number 1, is it a mutual company? Do they have a solid track record of paying a dividend? But also number 3, is the company infinite banking friendly? Meaning if you open up a policy with the intent of having cash value to you actually use for its intended purpose, is the company going to ease the process of you taking out those policy loans, or are they going to be a hindrance? I can think of one company off the top of my head. If you want to know what it is, shoot me an email, comment down below. Maybe I'll say it publicly. Oh, by the way, it is YouTube, so make sure you like, subscribe, and share this with somebody that you know that would find it helpful. Drop a comment down below if you have any questions. I'd be happy to help you out. If you want to know more about what a policy like this could specifically look like for you, feel free to reach out to me, comment down below, shoot me an email, schedule a call with me. No pressure at all. Really just take a look at your financial situation just to see if this is something that could even work for you right now. So drop a comment, let me know. I'm glad you stuck around if you stuck around this long, but I'll see you in the next one.